Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, without any further ado, let's take a look at some of the benefits of implementing credit spreads. Well, first of all, Steve essentially mentioned at the beginning that as volatility expands in the market, we see an increase in price for in options, and of course that's reflecting the risk in taking the other side of that particular options position. Now we're going to talk about that a little bit more, but the nice thing about using a credit spread as a mechanism for taking advantage of that is that unlike the naked option seller who is selling an option and collecting a premium because of that increase in volatility, the credit spread trader is actually identifying their risk by utilizing another option contract to limit that risk exposure. So what credit spreads allow us to do is allow us to sell expensive options, take advantage of that increase in market volatility, but at the end of the day, we're identifying our risk exposure. What we're also able to do is we're able to put the element of time depreciation on our side as well. So obviously when we're an option buyer, so when we're looking to buy a call or buy a put to take advantage of a directional bias, we need to be very well aware of the concept of time depreciation and recognize that if we're not managing our positions properly and not managing them proactively, then we run the risk of losing our entire premium. Well, as the credit spread trader, we're putting that element of time depreciation on our side. So in other words, we can profit if the pair stays the same, goes down a little bit, goes up a little bit, or again trades sideways. We can still profit, provided that at the end of the expiration date, the pair value is either above or below the particular option contract that we've sold. Now, as I said, just to reinforce, this means that we even if the pair value stays at the same price, we're still going to make our profits. So unlike the long option holder where we need that movement, we can profit using a credit spread if there's no movement at all. Now, as of the last few days, obviously, that hasn't been the case, but recognize that we can take advantage of a market that is trading sideways by utilizing these strategies. And in fact, we can combine credit spreads to take advantage of that even further with a pair value that happens to be trading within a range. Now, the idea is that we can create positions monthly. So we want to take a look at utilizing near-term options that are expiring within what we call the front month and ultimately generating that cash flow on a month-to-month basis. So we're not giving the particular pair value a lot of time to make a move. We're selling the option contracts, we're creating the spreads, and the idea is that they're expiring within the month, and then we're moving on, reassessing the underlying pairs, and then ultimately looking to reposition with another credit spread based on the characteristics of the chart at the time. Now, just a question from Michael with respect to lack of volume and open interest. I'll tell you one thing with respect to these ISE-FX options is that the ISE and the market makers have done a very good job at ensuring that there is liquidity. So I find that provided that you're focusing on and taking into consideration the what I'm going to talk about here moving forward this evening, that you can very easily and effectively create a spread strategy that brings in a decent premium. And again, we're going to talk about that moving forward. Now, the nice thing about these strategies as well is that depending on what broker you're trading with, there's always the question of commissions. And of course, whenever you create a multi-leg strategy, which is what the credit spread would be as we move forward, you're going to be paying commissions for it. The idea, of course, with a credit spread is that you want all of the options to expire worthless. So ultimately, provided that you've selected the appropriate strike price and that the trade has gone in your favor, you're only going to be paying commissions on one side of the trade. So you can sit back and let the options expire worthless on the expiration date and not have to worry about having to pay out those commissions, which tends to obviously eat at the profitability of many of these multi-leg strategies. Two types of credit spreads that we look at when we're considering taking advantage of a particular opportunity. The first is what we would refer to as a bear call spread. And the reason why, of course, it's referred to as a bear call spread is that we're utilizing calls. So our objective is to sell the call option, recognizing that as the pair value goes down in value, the call option will depreciate and will ultimately collect that credit. So with a pair call spread, we're selling the call options when we believe that the pair value is going to go down or stay below a specific strike price. The second type is, of course, is a bull put spread. So the idea is that we're going to be selling puts if we believe that the pair value is going to ultimately go up or stay below the put options that we've looked to take advantage of. Now, we talked earlier on about the idea of taking advantage of expensive options, and this is always, particularly in a market environment that we're in right now, where we've seen such an increase in implied volatility, many more advanced option traders will recognize the benefit of being a seller of the option contract. And a lot of, particularly people that come through our program, step back and they say, well, why wouldn't I want to just sell those option contracts naked? I've got the capital in my account to cover it. I have enough margin to cover a naked put sell or a naked call sell. But we have to understand that those options are expensive for a reason, and the reason why that they're expensive is because the market maker and the market in general is recognizing that the probability of those options or of the underlying security, in this case the pair value, moving towards and beyond the strike price is high, and so they're going to command a more expensive premium for that. So the way I try to illustrate this is when we look at it in comparison to an insurance company who has to take the risk on car insurance. If I'm a bad driver and if I represent risk to the insurance company, well, the insurance company is going to raise my premium. So regardless of whether or not I've got into an accident over the last little while, the bottom line is there is risk, and I will pay a higher premium because I represent a greater risk. And so we have to understand that that same rule applies in the options market. When the market makers identify that there is a higher probability of risk, then the premiums will increase in order to compensate for the fact that they have to take and assume the other side of that transaction and assume the risk.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.